I mean, I don't know how I could be anything but positive on the price of gold. I mean, first of all, if you look at a chart, we're in uncharted territory. There is no resistance. So it looks like a big breakout. Gold went through a long consolidation from 2011 to 2024, where it kind of traded between, 1,500 and 2,000 up and down. But that was after the big breakout from 2001 to 2011, where gold went from sub 300 to almost 2,000, about 1,900. So we've consolidated those gains. We broke out this year. I don't think gold's going back to 2,000. I think that's a history now. And we're off, to much higher levels without any resistance. So I think the price of gold can double, can triple from here, and potentially go much higher than that.
Were you a little concerned about how fast it went up? I mean, were you looking at a consolidation? It seems to be healthy here.
Didn't go up very fast. Yeah. I mean, it was a big move. In fact, prior to the election of Trump, we were on track for the biggest percentage gain in gold since 1979. Now, we still might get back on track for that, depends on how December goes. But even if it's not as, the best since 1979, it's one of the best years. Gold's up about 30%. And more significantly, so far this century or millennium, since January of 2001, gold has outperformed the S&P. In fact, it's outperformed all the major stock market indexes. In fact, you can go back to 1999 from the bottom of gold, when gold was, close to 250, and it's outperformed everything since 1999. So you're talking about close to 25 years where gold has beaten the stock market, yet there's no euphoria for gold. There's plenty of euphoria in the stock market. Nobody cares about risk there. But take a look at what's happened to gold stocks. Gold stocks are still down 15% from where they were 2 weeks ago, just before Trump was elected. Gold itself is down less than 3% from its peak. And it's barely down. I think it closed Friday at $27.15. When Trump was elected, maybe it was $27.50, down $35. That's it. Well, I just think there's not a lot of conviction in gold. And I think that the investors who might normally be buying gold stocks, are buying Bitcoin ETFs, or they're buying MicroStrategy. Remember, retail investors have been selling gold all year, and the selling was particularly strong early in the year when people thought that 2,000 was the top, and so people wanted out. The reason the price of gold has been going up is because foreign central banks have been buying. And obviously they know something that the typical retail investor doesn't. They're wasting their time on fool's gold, but they're buying the real thing. You do probably have the Chinese, consumers. They're buying, or in India, but in the U.S. and Western Europe, there hasn't been the interest. There's been more skepticism, and so we keep climbing that wall of worry. I think at some point the price of gold is going to rise high enough that greed is going to start to replace fear in the market, and then you're going to start to see investor interest really picking up in the mining stocks. And I think they have a long way to go just to catch up to where they should be, let alone to get ahead of the curve, which ultimately they will. The gold stocks will start anticipating higher future gold prices and pricing that in to the present stock price. So we haven't gotten anywhere near that yet, but it's coming.
Peter Schiff's insight into the current state of gold and silver markets is both sobering and enlightening. It highlights the incredible journey of gold over the past 2 decades and sheds light on the contrasting realities of true value versus speculative hype. To fully grasp the nuances of Schiff's argument, it's essential to explore the fundamentals driving the gold market while debunking the misconceptions surrounding Bitcoin. Gold, as Schiff aptly puts it, is in uncharted territory. The precious metal has broken free from years of consolidation, rising above $2,000 per ounce and showing no signs of slowing down. Schiff's confidence in gold doubling or even tripling from its current levels is rooted in sound financial principles. Unlike fiat currencies, which governments can print endlessly, gold's finite supply and intrinsic value make it a reliable store of wealth. This fundamental characteristic has been true for millennia and remains unchanged despite the advent of digital assets like Bitcoin. The journey of gold from $300 per ounce in 2001 to its current levels of over $2,700 is a testament to its resilience and ability to preserve purchasing power. During this period, gold has outperformed major stock indices, including the S&P 500. Yet, as Schiff points out, there's no euphoria surrounding gold. The media and retail investors remain fixated on tech stocks and cryptocurrencies, neglecting the steady and reliable gains that gold has delivered. One of the most intriguing aspects of Schiff's analysis is his observation that gold's rise has been fueled not by retail investors, but by foreign central banks. Countries like China and Russia have been aggressively buying gold to diversify their reserves and hedge against the devaluation of the US dollar. This quiet accumulation underscores the strategic importance of gold in a world increasingly marked by geopolitical tensions and economic uncertainty. Schiff contrasts this with the speculative mania surrounding Bitcoin, which he describes as fool's gold. The rise of Bitcoin has been fueled by speculative fervor rather than intrinsic value. Unlike gold, Bitcoin lacks the fundamental properties that make it a viable store of wealth or medium of exchange. Its extreme volatility, dependence on speculative demand, and vulnerability to regulatory crackdowns make it a poor alternative to gold. The idea that the US government would sell its gold reserves to buy Bitcoin, as proposed by some policymakers, is, in Schiff's words, treasonous. Gold, with its deep and liquid market, provides a reliable safety net for the US economy. In contrast, Bitcoin's illiquid market would collapse under the weight of significant government transactions, leaving taxpayers holding the bag. Schiff also takes aim at the political influence of the crypto industry, which has successfully lobbied for favorable regulations and policies. The irony, he notes, is that Bitcoin was created as a decentralized alternative to government-controlled money. Yet its current value is heavily dependent on government adoption and intervention. This contradiction highlights the shaky foundation upon which Bitcoin's value is built. For Schiff, the ultimate vindication of gold lies in its ability to withstand the test of time. While Bitcoin's future remains uncertain, gold's track record speaks for itself. It has preserved wealth through countless economic cycles, wars, and political upheavals. As Schiff concludes, gold's role as a cornerstone of the global financial system is secure, and its value will only grow as the world grapples with the consequences of monetary debasement and fiscal irresponsibility.
Your thoughts?
Well, I think that's basically treason on the part of Loomis to try to say we should squander our gold assets on Bitcoin. It'd be one thing to just even recommend buying Bitcoin, but to say to pay for it by selling our gold. But, she wants to say it's not going to cost the taxpayer money because we're just going to sell this worthless gold, that we, it's just gathering dust at Fort Knox. We'll just sell that. But of course, it's going to be highly inflationary because now the people who own Bitcoin, who sell it to the US government, have a lot of cash to go out and buy stuff. But at the end of the day, Bitcoin is not a viable reserve. Because what makes gold a good reserve is that if the U.S. government ever needed to sell the gold in an emergency to prop up the dollar, there is a very deep liquid market that could easily absorb the selling. But if the U.S. government tried to sell a significant quantity of Bitcoin, the market would crash. In fact, the only reason that Bitcoin is, knocking on the door of 100,000 and probably going to be through by the time anybody sees the interview, right? Yeah. But the only reason it's there is because everybody expects the U.S. government to buy millions of Bitcoin, to spend billions and billions of dollars, waste taxpayer money, which I think is really the ultimate irony, because Bitcoin was created as supposedly this is the alternative to government, where it's decentralized, we're rejecting fiat money and government, yet now it's completely dependent on government because it's the government that's creating all the demand. And so it's not that the free market is choosing Bitcoin, it's that government is using the coercive power of the state to basically force people to buy Bitcoin. Because when the U.S. government buys Bitcoin, I'm an American citizen. I'm not choosing to have my tax dollars used to buy Bitcoin, right? The government is doing that against my will. But what's happened is you had all the money in the Bitcoin industry, the crypto industry was able to corrupt all these politicians by donating to their campaigns and funding them. And the payback, right, with the return on that investment that they're looking for is the government to buy Bitcoin. They also want the government to make the gains on Bitcoin tax-free so they can sell all their Bitcoin to the U.S. government and pay zero taxes on the gain. So it's a great deal for them, but it's a disaster for the country. Hopefully, Donald Trump, stands up to this and doesn't sell out the country to the crypto crowd.
All right, we got 8,000 tons of gold on the balance sheet, the largest gold reserves in the world, priced at $42, $22 an ounce. I mean, what about Cynthia trying to say, okay, let's put this at current market value?
Well, it's already at current market value. Everybody knows what it's worth. Nobody claims that it's $42 an ounce, and the government certainly wouldn't sell it for $42.22. It just shows you how much value the dollar has lost since we went off the gold standard. Now you need $2,700 to buy what you could have bought for 42. And in fact, you could have bought it for 35 in 1971 when we closed the gold window. So that price doesn't mean anything, and it doesn't create some kind of windfall to say, oh, let's value it at the market and then sell it, get rid of our gold. Right. That would be the worst monetary mistake the U.S. could make. Remember, the British sold a bunch of their gold back in 2000. They marked the low. They sold that at about $250 an ounce. Now, certainly, it's higher price now, but given all the inflation that's been created and will be created, it makes no sense to sell it, especially if the goal is to buy Bitcoin instead of gold. Because Bitcoin has none of the attributes that give gold its value. It's counterfeit gold. I said it's fool's gold. And it would be horrible if the U.S. Taxpayer, American public, was the final bag holder in Bitcoin. The exit strategy for the guys that got in early in this Ponzi pyramid chain letter, however you want to describe it, they ran out of chain in the free market. They got Wall Street involved with all the ETFs, but that couldn't do it. And that I think if Trump had lost this race, Bitcoin would be collapsing right now. So rather than being almost at 100,000, we'd probably be below 50,000 and falling fast.
Peter Schiff's critique of speculative assets and his unwavering belief in the enduring value of gold and silver deserve deeper exploration, particularly in light of the evolving global financial landscape. Let's delve further into the risks, opportunities, and implications that Schiff foresees in the coming years for these precious metals and their speculative counterparts. Schiff's skepticism about Bitcoin and speculative markets is grounded in the principle that intrinsic value, rather than hype, should drive asset prices. Bitcoin's meteoric rise to nearly $100,000 has created an illusion of wealth for many investors. However, as Schiff argues, this wealth is built on a foundation of speculation, not substance. Unlike gold, which has intrinsic value derived from its physical properties, Bitcoin's worth is purely notional, dependent on the belief that someone else will pay more for it. When speculative bubbles burst, they leave behind economic scars, wiping out the savings of those who bought into the hype. The dot-com bubble of the early 2000s and the housing market crash of 2008 are stark reminders of how irrational exuberance can devastate financial systems. Schiff predicts a similar fate for Bitcoin, as its value is disproportionately reliant on regulatory leniency and speculative demand. While retail investors chase speculative highs, central banks around the world are quietly amassing gold. Schiff points out that these institutions are not buying Bitcoin or other cryptocurrencies. They are buying gold. Why? Because gold has proven itself as a reliable store of value for millennia. Central banks understand the risks associated with fiat currencies and are using gold to hedge against those risks. China and Russia, for example, have significantly increased their gold reserves in recent years. This is part of a broader strategy to reduce their reliance on the US dollar, which has been weaponized through sanctions and other economic measures. By accumulating gold, these nations are preparing for a potential shift in the global financial order, where the dollar may no longer reign supreme. The implications of this trend are profound. As central banks continue to buy gold, they create a floor under its price, ensuring long-term stability. This trend also underscores the growing recognition of gold's role in a multipolar financial system, where multiple currencies, rather than a single reserve currency, share global dominance. One of Schiff's most compelling arguments for gold is its role as a hedge against the declining value of fiat currencies, particularly the US dollar. The dollar has lost over 95% of its purchasing power since the Federal Reserve was established in 1913. This erosion has accelerated in recent years, as the U.S. government has resorted to unprecedented levels of money printing to fund its deficits. The national debt now exceeds $36 trillion, and the annual deficit is running at over $2 trillion. These numbers are unsustainable, and Schiff warns that the only way out is through inflation. reducing the real value of the debt by debasing the currency. In this scenario, gold becomes an essential asset for preserving wealth. The current economic environment bears striking similarities to the 1970s, a period marked by stagflation, high inflation coupled with stagnant economic growth. During that decade, gold surged from $35 per ounce to $850. Schiff predicts a similar trajectory for gold in the coming years, as inflation erodes the purchasing power of fiat currencies and drives investors toward real assets. While gold often takes the spotlight, Schiff emphasizes the unique opportunities presented by silver. Known as poor man's gold, silver is more than just a precious metal. It is an industrial commodity with applications in renewable energy, electronics, and medical technologies. As the world transitions to a green economy, demand for silver is expected to skyrocket. The silver market is also characterized by significant supply constraints. Annual mine production of silver is just over 800 million ounces, while industrial demand continues to grow. This structural deficit creates a bullish case for silver, particularly as investors recognize its value as both a safe haven and an industrial necessity. Schiff believes that silver's price could eventually surpass its previous all-time high of $50 per ounce, achieved in 1980 and briefly in 2011. The metal's historical volatility means that when it moves, it often outpaces gold on a percentage basis, offering substantial returns for investors who time the market correctly. Another area where Schiff sees untapped potential is in gold mining stocks. Despite gold's strong performance in recent years, gold stocks have lagged behind. This disconnect presents a compelling opportunity for investors. Historically, gold stocks have provided leverage to the price of gold, often delivering 2 to 3 times the returns of the metal itself. The underperformance of gold stocks can be attributed to skepticism about the sustainability of gold's rally. Many investors believe that the current price of around $2,700 per ounce is a temporary peak, with prices expected to return to the $2,000 range. Schiff disagrees, arguing that gold is on a long-term upward trajectory. As this reality becomes apparent, gold stocks are likely to experience significant re-ratings, providing outsized returns for early investors. Schiff also highlights the political and regulatory challenges facing the financial system. He is particularly critical of proposals to sell U.S. gold reserves to buy Bitcoin. Such a move, he argues, would be a catastrophic mistake, undermining the nation's financial stability in exchange for a speculative asset. The political influence of the crypto industry is another area of concern. Schiff warns that the industry's lobbying efforts could lead to misguided policies that prioritize short-term gains over long-term stability. For instance, the push for tax-free gains on Bitcoin sales could incentivize speculative behavior while depriving the government of much-needed revenue. In contrast, gold offers a stable and proven foundation for monetary policy. Schiff advocates for a return to a gold-backed currency system, which would impose fiscal discipline and restore trust in the financial system. While such a transition would be challenging, it would address the root causes of economic instability and create a more sustainable future. Schiff's message is both a warning and an opportunity. The risks associated with speculative bubbles and fiat currency debasement are real and imminent. However, for those who recognize the enduring value of gold and silver, the future is bright. As the global financial system faces unprecedented challenges, gold and silver offer a safe haven for investors seeking to preserve their wealth. Whether through direct ownership of the metals, investments in mining stocks, or a combination of both, these timeless assets provide a hedge against uncertainty and a pathway to prosperity. In conclusion, Schiff's insights remind us of the importance of fundamentals in a world driven by speculation. While Bitcoin and other cryptocurrencies may capture headlines, it is gold and silver that will stand the test of time. For investors who understand this, the rewards will be well worth the patience and conviction required to hold these precious metals in the face of market noise.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.